Hi, everyone. Thanks for joining us today. My name is Sandra. I'm the principal broker with the Mortgage Center. We have about 20 people registered, but I also want to start on time to respect those people who have joined us today. And we are recording the webinar, and it will be available on our site, on our YouTube site, the Mortgage Center Guelph. Uh, Probably later this week. Okay, awesome. Thank you so much for joining us. So, as for those of you who don't know me, I am the principal broker, the Mortgage Center franchise in Guelph. And what's really interesting, and I'm going to talk a little bit about this later, is just how our business has changed. Because before I used to always introduce myself as Guelph, but now we're really serving people. Guelph and the surrounding area, so probably about 25 to 30 kilometers, because we just have such a great following. I've been in business for 20 years. I think I've done 11,000 mortgages, and most people that we encounter who are our clients appreciate that advice. And I know you, as a realtor, also appreciate someone who knows what they're doing when it comes to financing. So I'm going to be pretty. I'm just checking the time. I'm going to be pretty. Run through this with a pretty quick pace. And what I was hoping to do is just talk a little bit about rural financing for probably about 10 to 15 minutes. I wanted to also spend a couple of minutes near the end of the presentation talking a little bit about some of the watch outs that we're seeing in our office. As a real estate agent, you want to be um, uh, know what's happening. And then I'm going to wrap things up with sort of what's happening with interest rates and kind of give you an example on what we're seeing with interest rates. So I'm hopefully going to get to the end of this in about 20 to 25 minutes. So you'll want to hang in there with me because there's just some really interesting information that we're seeing in our office that I thought I'd share with you to help you as a real estate agent. So the types of properties in rural areas, and as you know, what we're finding in our office is especially from like Guelph towards London and Guelph towards Orangeville, more and more people are looking to rural type properties, and the main reason it's because they're more affordable, and also people's dynamics around working have changed, especially those folks who worked in what I would say white collar jobs, like office type jobs. Many companies have made it. I actually just did a mortgage for somebody who works at Shopify, and they're moving from Guelph to Newfoundland to be closer to their parents or their family. And Shopify, for example, has just said right across the board, we're not asking anybody to come back to work in the office. So you can pretty much work wherever you want. Now, that is not the norm, but I think more and more people are considering rural properties. It will be interesting to see with the sustained price of gas, and if that will continue, because I think more and more people will move to sort of greener or different types of transportation because they weren't anticipating a liter of fuel to be $2 or more. So there are different types of rural properties. There's rural residential, agricultural, and commercial or central business district. And they will trip up financial institutions and they will trip up your client. So it's really important to refer your clients to some like a mortgage broker because they have different options and they understand the zoning and the different requirements from the lender. So for example, as a mortgage broker, we do mortgages for TD and Scotia. We do mortgages for most credit unions. So we have that that ability. One of the interesting things, and some of you actually referred clients to me, many smaller towns have, if you think about like, it's clearly zoning can be an issue because it's clearly a property that's used as a residential uh, for residential purposes, but it's in the central business district or it is designated as commercial zoning. And that really can trip up the financing because if you look at the MLS, you'll see C1 or commercial zoning. And as soon as the lender sees that, they're like, no, this is commercial, even though it's clearly residential. So property and understanding property types, and making sure that when you put an offer on, and what we're finding is that offers now are starting to come in with some conditions. If you can always send us a copy of the MLS with the seller's name on it, the detailed MLS sheet, and the purchase agreement, even before it's signed off, we can do a little bit of due diligence to, oops, to help you make sure that your borrowers don't have an issue with financing. With agriculturally zoned properties, one of the things that trips financial institutions up is many agricultural properties have some sort of business associated with them, or they may have large arable acres. So, for example, for residential financing, how the property is appraised is the house plus 10 acres. Some institutions will allow 20 acres, but if there is 100 acres or 500 acres to the property, that could be an issue to get residential type financing because of how the property is valued and depending on the down payment. Some of the other considerations with rural properties and financing is water potability tests. I know things have been a lot slower now to get those water potability tests approved. Oftentimes what we're doing just to kind of keep the process moving forward is we're asking lenders to make water potability tests a condition of for the lawyer, so that can happen near the end. However, there is a danger for that because we're assuming that the customers are buying a house that has potable water, right? And if it's not potable, then it's got to be corrected before closing. Well, in septic systems, what we're also finding is more and more borrowers or clients of ours need to get alternative financing for properties because it's more challenging to qualify for a mortgage. Or let's just say they've been they're self-employed and they don't show a lot of taxable income on their personal tax returns. With alternative financing, well and septic can be an issue. And how we sort of mitigate that is um, oftentimes borrowers will have to come up with more than 20% as a down payment. And it kind of depends if it's a well and septic in a very rural area versus a well and septic in more like rural kind of hamlets. That is also a consideration. So again, well and septic systems, sometimes when the borrower has to do alternative financing, and we're finding more and more borrowers have to do that, we're requiring, and the lender's requiring longer, more down payments. The next point is longer closing dates than urban. So this sometimes happens. We have lots of clients who have purchases that are closing in August and September because these properties tend to be larger, more complicated. They do end up having longer closing dates. So that's actually a benefit because then all of these issues can be sorted out. And in the past, I mean, things are changing in the market on a daily basis. Um, Sometimes there were offers that clients had to put in without a financing condition. But because of how these properties are valued through an appraisal, and 99% of them, well, if your client is putting more than 20% down, it's a high likelihood that they will have an appraisal on the property. So how we were circumventing some of these financing conditions is we were working with the realtor to insert an appraisal condition. Because it's not necessarily the financing that's going to be the problem because we've pre-approved the borrowers, we've verified their income, pulled their credit history. It's the condition of the property or the location of the property that might be an issue. And then obviously the other consideration for rural financing is home insurance. Because if the borrower can't get home insurance or decent home insurance, then they can't get the mortgage. Um, and with home insurance, if you are working with clients who are buying in a rural area, you want to sort that out at the beginning. So, because sometimes what we do is we get clients say, well, I didn't expect that the home insurance was going to be $300 a month, right? And so that's kind of eats into their monthly budget. This idea of purchasing a property over a million is pretty much common, very common these days. And the reason why I'm bringing this up is it's not just true with people who are buying in a rural or a rural area. And I noticed that there's a chat here. Will, you've got a great question here, and I'm happy to table that when I'm finished a part of this presentation. So I'm so glad you asked. But those people who are purchasing over a million, regardless of whether or not it's in a rural area or urban area, cannot get those mortgages insured or get what's called insurable rates. So I don't want to kind of get too far into the weeds, but for the types of loans that we do, many wholesale banks or monoline lenders will provide excellent interest rates if the mortgage is insurable. And what insurable means is that means it's a purchase and it's under 1 million. And what the lender does is they back end and insure the mortgages through CMHC or Genworth um, or one of the insurers. And the borrower doesn't pay for the insurance premium. This is if the borrower has 20% down or more, but the lender pays the insurance. However, there's a regulatory requirement that purchases over 1 million cannot fall into that insured category or in that insurable category. Now that will likely change. That was one of the platforms that the federal government was running on, the current Liberal government was running on, and they were suggesting that insurable or insured mortgages, the limit goes to 1.25. So because the mortgages aren't typically insured or insurable, when the mortgage isn't back end insured or the client doesn't pay the insurance premium, how mortgages now work is that the rates are typically higher. So we often prepare clients, they're like, well, how does it make sense that and rates are higher now anyway, but rates are quite a bit higher. So we're going to look at some of those interest rates and I can share that with you. There is also an issue around something called sliding scale. So I just actually encountered somebody who was buying a property for 1.5 million, and they had their mortgage for with CIBC, and they only wanted to put 20% down because they wanted to hold back some of the equity from the sale of their house to do some upgrades to the current home that they were building. But because of CIBC's sliding scale, if they were buying for 1.5 million, they had to put 500,000 as a down payment. Whereas we were able to get them approved based on a sliding scale where the lender would go to 1.5 million and allow it only a 20% down payment. So that was huge because instead of the borrower having to put 500,000 as a down payment, now they were only looking at 1.3 million. At 300,000. So this sliding scale can really affect people's ability to buy the house, because if they're buying a rural property that needs some TLC, they may not be able to hold back the equity from the sale of their house to do upgrades. The other thing I wanted to show you this impact of the sliding scale. So this is an example of someone buying for 1.2 million, and it's quite common not only in rural areas, but urban areas. So for example, lender A required 20% down on the first 1 million and then 50% down on the balance. So you can see we've done the math here, and this financial institution will require a $300,000 down payment for a purchase of 1.2 million, whereas this sliding scale, lender B, is a bit different. So lender B, 20% down on the first 750,000 and then 50% down on the balance. And so you can see here that based on the calculation, lender B would require 375,000 for the down payment on the same purchase. So understanding this concept is important for borrowers. We actually go through this all the time with clients, but again, it's becoming more and more common because in rural areas it is quite difficult, depending on where you're looking for to get a property for under $1 million. I wanted to shift gears a little bit, and I'm going to be careful of the time. So it's 11:15, and I know you guys are busy professionals. And I wanted to talk to you a little bit about some of the, I'm just going to stop sharing my screen here, some of the watch outs that we're seeing on the market in our office. And I'm kind of drawing the curtain behind a little bit and showing you some of the things that we're seeing in our office to help you. One of the things that we're seeing, and I think I'm working with 3 customers right now, where they put offers on a purchase in the spring, and the closings are coming up now, and they've not sold their primary residence, their current home that they were moving from, firm. And it's still conditional on the buyers of the house that they're selling. So again, let me just repeat that. So I've had clients who put offers on a house in the spring, no conditions, with the idea that they were going to be closing in July or August and shouldn't have a problem selling their house. And now they're having a challenge selling their primary residence. So one of the things that I wanted to let you know is if you find your client is in this situation, we can definitely help them, and we can do a private bridge loan. So it is fairly expensive. I am working with a client, but it's better than not closing, and you know that as well. So for example, I'm working with someone right now who bought a property, I think it was in April, and it's closing on June the 14th. Imagine that. I got a call a couple of days ago and they still have a conditional offer on their sale. And they're buying a property for 1.2 million. They have equity in their existing home. And so what we ended up arranging for is a private bridge loan that's blanketed against both properties. So the loan doesn't actually have to make payments, um, but the payments will be made when they sell their house. So again, they don't need to come up with any money for the down payment because they have a lot of equity in their primary residence already, the one that's being sold that hasn't sold yet or is still has a conditional offer on it. But just to kind of give you an idea, that bridge loan, if they end up having it for 60 days, so if their house is on the market for 60 days and they can close in 60 days, is probably going to cost them close to $50,000. And that's on a $1.2 million loan. So it is fairly expensive, but it can be done. So I wanted to kind of draw your attention to that's a trend. And as I said, I usually deal with those kinds of situations 1 or 2 a year. I've got 3 that I'm working on right now. Appraisals. We did a really great webinar. Again, you can go to our website, our YouTube channel, the Mortgage Center Guelph, and listen to myself and a CEO of Value Connect, which is an appraisal management company. So they don't actually do appraisals. They facilitate the appraisals across Canada. So most brokers and mortgage banks require a third party to sort of negotiate the appraisal process. And the main reason for that is it's a regulatory requirement around the issues of colluding in values. And what we actually had a great conversation at the webinar. And one of the things that he talked about was if your client is putting an offer on a house and it's accepted, don't have the borrowers wait to the end to do an appraisal. Because as you know, the value of a property right today might be different in September. And so you want to make sure that if they're buying something, an appraisal is required. And I can tell you that if the customer has 20% down or more, you're likely going to have an appraisal because appraisals primarily occur when it's a non-insured mortgage. So make sure that if you've got a client that's got an accepted offer, follow up with a mortgage broker or bank and understand whether or not an appraisal is required and get that appraisal done early instead of waiting near the closing date because the value will change. And remember, financing is based on the purchase price or the appraised value, whatever's less. Okay. The other thing, the watch out that I thought we could maybe share, I could share with you a little bit is around mortgage approvals and pre-approvals and the qualifying rate. Right now on a 5-year fixed rate mortgage, we're looking at somewhere in the area of 4.79%. Okay. And how the mortgage approvals work with standard prime lenders, this is banks and wholesale banks. They'll look at the contract rate, which is 4.79 plus 2 or 5.25%, whatever's lower. Okay, so if your client is doing a 5-year fixed rate mortgage and their current rate is 4.79, they have to qualify based on 6.79, and that really decreases the amount that they can qualify for. If your clients are on a variable rate mortgage, the stress test rate of 5.25 still applies. So any clients that you have that are pre-approved, you want them to revisit that pre-approval because depending on whether or not they're going to choose a variable or a fixed rate mortgage, that amount that they're qualified for would decrease. So those are some of the watch outs that we're seeing. And then I think we're pretty good for time. So what I'd like to do is I'd like to share with you a little bit about what's happening with mortgage rates. And I'm going to just do a screen share here with you. And we can just spend the next couple of minutes looking at interest rates. So give me a second. So as you know, we do mortgages with TD and Scotia. So I wanted just to share with you a little bit about what's happening with TD, just to kind of give you a bit of a comparison. So this is sort of what we're seeing with interest rates with TD. And just kind of give you an idea. So you can see here for fixed rate mortgages, these are the posted rates. These are the interest rates on the 25-year amortization. Then we've got the 25 or more rental properties. So you kind of get a good idea of what's happening with interest rates. And then for variable rate mortgages, TD's prime rate right now, they're the highest on the market. They're at 3.85%. So they're at prime, TD prime minus 0.65. And you can kind of see what's happening with interest rates there. And they do have some high ratio specials. I don't know how much of a special that is, but you can kind of see. And remember how I said that high ratio mortgages, because they're insured, the rates tend to be a little bit better. Okay. And then we also do mortgages with First National Financial. They're like the wholesale division of RBC. And some of you have already seen this rate sheet, and this is the rate sheet as of June the 1st. But this is really great because it shows you how the different insured mortgages, insurable mortgages, and then the non-insurable mortgages. So rural properties or any properties that would be over 1 million, you can see here what the interest rates would be because these are uninsurable because it's over a $1 million value on the property, and these people require a 30-year amortization. So you can see here, First National's prime rate is 3.7. So how you would read this here, if it is 4.84%, which is a little worse than TDs, right? And that's a benefit of working with a broker is we have these different options and can review them with borrowers. But their prime, which is 3.7 minus a half. So it's a little bit better than TDs, right? And then there are some lenders, like most of the monoline or wholesale lenders have something called rate option plus. These are typically like lower rates, but there is a caveat with them, and they have like a higher penalty. So again, this is something that we would go through with borrowers. You can see here, if a client is getting a high ratio mortgage, the interest rate is fairly good. Look at this, prime minus 0.9. So if the prime rate was 3.7 minus 0.9, you're getting 2.8. And so I just wanted to remind you that there is a difference between adjustable and variable rate mortgages. Adjustable rate mortgages, the payments stay the same. And as the interest rates fluctuate, the amount that goes towards principal and interest changes. Variable rate mortgages, the interest rate varies and so does the monthly payment. So that's also a kind of another thing that we explain to borrowers, the difference between adjustable and variable rate mortgages, because both are floating rate mortgages. So that wraps things up, and there are a couple of questions. So if I could just kind of tackle those questions. But as you know, I mean, I don't have to tell you, that's why you're on this call today, is we do some amazing work here. You want to send your clients to a mortgage broker because there are some exceptions we can grant. And we also, the really cool thing is that if you have somebody who's thinking about buying, even if it's a 1 year ahead, have them contact us. Because we can get them pre-approved if there's an issue with their credit, we can help solve that so that when they're ready to buy a house, you're not going to have problems with financing. The other thing I should mention to you is people just love working with us. And if you just Google the Mortgage Center Guelph, you'll see all of the amazing reviews that we have from customers. We can do things online and virtually at the customer's convenience. So they don't have to come into like a gross office. I can't imagine going into an office right now. I'm a little bit shy, but we do have some elderly clients who prefer face to face. So we do make some exceptions on that. But I did also want to let you know that we've got this amazing app that you can download from our website. If you haven't looked at it, you should, because it's great for realtors. So you can just go to our website at skipthebank.ca, and there's a button on there and it says download an app, and you can download that app. And finally, it takes time to make these presentations, and I always value your feedback. So if you could do a Google review for the presentation, that would be great. Just Google the Mortgage Center Guelph or skipthebank.ca, and I think you guys know how to do a Google review. So thank you so much. I know that there's a couple of questions. So for those of you who need to say goodbye, I'll see you soon. And I'm going to just hang out for a bit and answer questions, any questions that people may have. Now, I've got a couple of questions from Will. Will, as you know, I'm just going to stop recording right now.